Welcome to the video newsletter for clients of Index Gurus Wealth Management. Hello, this is Farouk Jaffer, Certified Financial Planner Professional and Head of Index Gurus Wealth Management. The coronavirus shock has triggered an acceleration of key structural trends. As a result, I will discuss the impact of the last quarter, reasons for caution, consumer and business trends, and how we are positioning portfolios for success. The mood and the market has evolved at a furious pace since our last quarterly newsletter. The green line represents the performance over the past quarter of the S&P 500. I compared the performance to indexes of both emerging and international countries to show that America has outperformed. Our repositioning in quarter one out of international and developed markets has done well to maximize gains. Why did America do so well? It was due to our extraordinary policy response, shown as a red line. Compared to the other developed and emerging countries, our huge credit flows to businesses and governments allowed us to weather the storm caused by the corona pandemic. Fluctuation in the stock market has been unprecedented. The S&P 500 index notched more positive and negative 4% moves in 17 trading days through mid-June of this year versus an average of just 3.2 days from 1928 to 2019. We expect this trend to continue given upcoming uncertainties. The coronavirus is having an impact on growth. The red line shows the US above the rest of the pack compared to the Euro area, Japan, and United Kingdom. As a result, Index Gurus will continue our focus in domestic companies. The economic and market metrics are now trending in the right direction. The chart shows the change in the S&P 500 versus jobless claims, which is a key economic indicator that is headed in the right direction. Thanks to our policy response, the stock market is headed in the right positive direction. The coronavirus pandemic is a novel virus which has no similar precedent. A new round of infection is possible, and its burden on the healthcare system and potential for renewed closures is unknown. The upside is that countries would enter a second wave wiser and more prepared, with greater availability of testing, protective gear, and drug interventions. The US-China relationship is further strained since the coronavirus crisis, defined by greater competition and less cooperation. The market volatility that we have experienced are likely to continue should tensions get worse. In addition, US onshoring and the likely move toward deglobalization will have inflation implications down the road. Stock prices are attractive relative to bonds, but by the most common measure of valuation, the PE ratio, some companies are not cheap anymore. As a result, it is important that we purchase companies at the right time and be intentional to invest in companies that will continue with positive earnings growth while there is economic inactivity. What if we enter a recession? It is possible that this may occur, but keep in mind that the average recession lasts only 13.3 months, while the average expansion lasts 60.3 months. Let's examine two big trends that are related to consumers and businesses. US households are now purchasing roughly 60% of the goods and services they consume online versus 50% in 2019. As you can see by this growth, this is one of the reasons technology companies' earnings and cash flows held up remarkably well relative to other sectors. There is also growing business demand. A recent poll of CEOs of Fortune 500 companies found that 75% of companies believe that the pandemic will accelerate technological transformation, which may result in increased technology spending. The societal changes as a result of this virus are likely to drive faster growth in a number of industries, such as online retail, communications, cybersecurity, and cloud computing. Other areas such as energy companies, brick-and-mortar retail, and auto part manufacturers may continue to face pressure from structural challenges. It is so important to practice diversification, even though it sometimes feels painful and comes with FOMO, the fear of missing out. Morningstar did a study comparing two portfolios over the past 20 years, comparing a growth portfolio to a diversified portfolio with 40% in income securities. As you can see, you would have actually come out ahead with a diversified portfolio. The next thing you can do is focus on your goals and not the news. Index Gurus is going to make sure you are well positioned in great companies that will weather the coronavirus pandemic. Rest assured, you're in good hands. Lastly, keep in mind that with proper positioning and guidance, the chances that you will be in the green after 1 year are 75% in your favor. The US has shown that they are willing to keep the economy humming, so it makes sense to stay invested. Research has shown that losses are more emotionally powerful than financial gains, which can lead to decision-making during periods of volatility that may hinder long-term returns. You can count on Index Gurus to help you implement our plan of action so that you can achieve your financial goals with peace of mind.